Hi, folks. This video is being recorded to provide you with some relatively recent trends in international economic and trade information. If you are in the international business course that we're conducting here at the Tillman School of Business at the University of Mount Olive. The textbook that you're using was written in 2010 and published in 2013. That's unfortunate because the data and the graphs in that book end in 2010. And in the last 8 years, a whole lot has changed. So the purpose of this video is to provide you with some more up-to-date information about international economic and trade trends. The material is somewhat detailed and voluminous, and yet I'm going to try to go through it just as rapidly as I can, so that you'll be able to review this material in one viewing. And so with that, I think the best thing to do is quit wasting time in introducing it and just get going. Let me see if I can get started here. There it is. Okay. So here we are in our course on international commerce, and we're going to be supplementing your textbook with some more recent trends. And that's if I can make this PowerPoint advance here. There we go. And this pretty much explains what I mentioned a moment ago, that what we need to do is simply update trends in the textbook. Frankly, this is a problem almost no matter which textbook we use, because the events, international economic and trade events, tend to change somewhere in the world pretty rapidly. So no matter when a textbook is published on this stuff, its exhibits become out of date pretty quickly. So even if such a long time had not elapsed between when this book was published and today, even if we had used a more recent book, chances are we'd still need to do something like this. Here, just to refresh your memory about the population, you see the U.S. population on the left, upper left. And don't forget that these trends go through 2022. So we've got to sort of look up here, and we see that the U.S. population today has about 320 million people. Compare that to the population of China, which today is just creeping up on 1.4 billion people. So, you know, you take our population and you add about 1.1 billion people to it, and you get the population of China. And another thing that's particularly remarkable is the trend in India's population. And as you can see, it will just be a few years at the most before India's population catches and surpasses China's. What's going on here? Well, as you've heard, China has had in the past a one-child policy. That policy ended about 3 years ago. But frankly, I was in China recently and just looked around, and I saw families with children, one child, and got to know them as best I could. They were very happy with that arrangement. And the reason is the economy is growing so fast that both men and women are working very happily, making more income than their parents did, that's for sure. And they have aspirations of career growth because the economy is just growing real rapidly. So one child's plenty, thank you. And that's about what they have time for. I'm sure they're still just as amorous, but that doesn't mean that they're going to have more children. Anyway, birth control is not practiced as widely in India. Now, the birth rate, or what is called the fertility rate, the number of births per woman, has gone down in India, but it's still over the replacement rate. I'm not sure of the number, but I'll say it's about 2.25, 2.25, 2.3, something like that. In the past, it's been more like 2.7 or 3 or more. Those rates still exist in some parts of Africa. But in China, just like the United States, the rate is a lot lower, and in China, it's less than 2. So what that means is that as time passes, China's population will turn back down. It's still rising slowly because of the number of people that exist and the difference between the birth rate and the mortality rate. But the mortality rate in China is declining, as is the birth rate. And so even though there are more people who are, because they're living longer, there are fewer people because there are fewer births. The mortality rate in India is higher than China, and the birth rate is higher. So no doubt about it, it won't be long before India's population is a lot larger than China's. I see forecasts for India in the neighborhood of $1.7 billion by the end of the century, billion people by the end of the century. And I see forecasts of China's population sort of leveling out at about 1.25 billion. So at the end of in the second half of this century, there's no question about it, India's population will be the biggest one on Earth. China's will be second biggest. And probably the U.S. will be third. We can also see some other important population trends down below. The population of Brazil, as you can see today, is something on the order of just about 200 million. It's a significant country in terms of population. We can see that Mexico's population, our southern neighbor, is something approaching 125 million, thereabouts. So, and of course, these demographics are strongly related to markets. And of course, the composition of the population, age group population, has a whole lot to do with market forecasting. So if we can understand the population dynamics or the demographic dynamics of the countries that we do business in, we understand a lot about their markets. So let's take a look at some economic trends now. And something that's extremely important, very, very important, is the way you calculate the value of an economy. Now, lots of folks still, and this includes regrettably some textbooks and some newspapers, will take the economy of a nation expressed in its own currency, such as Chinese yuan or Mexican pesos, whatever, and they'll translate that number, the Chinese economy in yuan, by the bank exchange rate. So many yuan to the dollar. So you take the number of yuan and divide it by that number, and that's the value of the economy in US dollars. Only it's not. That's wrong. And the reason it's wrong is because exchange rates can be manipulated by central banks, and China's exchange rate happens to be a great example. the Chinese government over the years has tried to keep its exchange rate low relative to the dollar so that that its goods and services can be exported more easily. It's easier for customers in other countries to buy with their currency more yuan's worth of goods and services than if the yuan were allowed to more faithfully reflect the value of the economy. So a project was done several years ago at the Wharton School of the University of Pennsylvania to come up with something called purchasing power parity. Purchasing power parity is expressed in dollars, but even US dollars can be adjusted for this stuff. But in any event, maybe an example, when I traveled to Japan years ago when I was consulting, I would ask my assistant to get me a couple $1,000s worth of yen, Japanese yen, and then I'd go to the airport and go to Japan. And the exchange rate then was something much higher than today. I want to say it was something on the order of 225 yen to the dollar. Today, I think it's about 125 yen to the dollar. Anyway, so after I got into my hotel in Tokyo and got up the next morning and went down to the coffee shop to order a cup of coffee. And by the way, in Japanese, the word for coffee is kohi. And they've picked up the word and we can actually speak it as Americans. I want a cup of kohi. Anyway, so if the exchange rate back then were 2.25 yen to the dollar, and if at that particular time a cup of coffee in the United States cost $1, then what should it have cost me in Tokyo? 225 yen, right? But it didn't. It cost me something like 350 yen. Why was that? And the answer is real simple. The yen doesn't buy as much coffee, did not back then buy as much coffee in Japan as an equivalent amount of dollars could purchase in the United States. So a basket of goods, a combination of goods and services was put together and is maintained because it changes over time at the University of Pennsylvania, or whoever's doing these numbers now. And the value or the amount of yen or Chinese yuan or Mexican pesos, whatever it might be, required to buy that basket of goods and services, that is essentially representative sample of the goods and services in the entire economy, is equated to the same amount of dollars that are required to buy the same amount of goods and services. In short, the purchasing power of currency is adjusted in this system so that you can more correctly, more accurately compare the value of economies. Now, if you look at this table in the center column, you can see the value, and we'll just look at the top two countries, the US and China, and we see that when this chart was done in January of 2018, the US economy was valued at about a little more than $18 trillion. And China's economy was valued at about $11.4 trillion. That's when you use the bank exchange rates. Now look what happens when you look at the true economic value, the purchasing power of those two economies' production, okay, the GDP, or gross national, sorry, this is gross national income. And we see that China's gross national income is substantially larger than the United States, 21.4 trillion compared to 18.75 trillion. In short, the Chinese economy is larger than the US economy. And the International Monetary Fund calculates the value of GDP for all the countries on this exhibit and several others in terms of purchasing power parity, as well as the value expressed in local currency and dollars when you use bank exchange rates. But the real number, the real basis for comparing economies' values, in my opinion anyway, is the use of purchasing power parity. And I think most economists today would agree with me on that. And they're over on the right, by the way. You can see the populations of the two countries at January of this year. And by the way, you can see that US was 323 million and China was 1,379,000,000. And India's was just catching up at 1,324,000,000. So won't be very long at all till India's caught up with China. Okay, this was kind of a detailed exhibit, but it's a very important point. Purchasing power parity is where it's at when you're trying to compare the economic value of nations' the true value of nations' economic output, their GDP. And here is a little chart that just summarizes these trends. You can see in the upper left-hand chart, the red line is China, and you can see that it is crossed through first the US economy and the fourth quarter of 2013, and the European Union, which at that time consisted of 28 countries. It won't be long before it's 27 because the United Kingdom, England and Scotland and Wales and Ireland are going to leave the European Union. But when this chart was done, it consisted of 28 countries. So no surprise that it's a little bit larger than the US, but you can see that the US and the European Union's economies pretty much march in lockstep. When you look at them under a microscope, then at the details, that's less the case. But what this chart says most importantly is that the Chinese economy is larger than either of those two others, and the gap is widening. The gap is widening. That is very important for international business folks to know, because in many respects, the growth economy of the world is China right now, and it won't be long before India's economy, which is also a growth economy. It's just not as large as China's is, and it's also got some difficulty that China's economy doesn't have. So, but you can see the line for India in the upper right, and it's taking off at a really rapid rate. And it's projected to grow even faster. There are some serious difficulties with India's economy, including political, regulatory, and sociological. I won't get into those now, but if you're in my course, we will have talked about them. You can also see and these data, by the way, are from the International Monetary Fund as well, and you can see that they're projected out to 2021. You notice the little line that I've attached to Brazil's economy, and notice how it has dipped down recently. It dipped down because, among other things, Brazil's had 3 presidents in the last 4 or 5 years. There's a tremendous political problem in Brazil. And the IMF projects that growth will resume virtually this year. Pardon me, there's a new election about to occur in Brazil. The current president, Michael Temer, has not got the prayer of he's not even going to run for re-election. His approval rating is something like 5%. And so there's going to be a fourth president. But if Brazil doesn't get its act together socio-politically, it's going to be very difficult for a government to function effectively. And although the IMF projects Brazil's economy to start growing again, that is not certain at all. And then the dotted line below is Mexico. Again, we're always interested in it because it's our southern neighbor, and it's not a trivial economy. And there's a lot of trade between Mexico and the U.S. Here's another indicator. It's GDP per capita. Notice it's GDP purchasing power parity per capita. And it certainly is not a projection of consumer spending, but it is an indicator of consumption potential. So you can see now in the upper left chart that what was true in the last slide is the reverse here. The GDP per capita, the index of living standards, if you will, for China is the lowest on this chart. The European Union is still in the middle, and the U.S. is at the top, which should be a surprise to no one. Take a look now. Be very careful. You see, it looks like India's on the upper right-hand chart is outdistancing those on the left, but you've got to pay attention to the scale. So we can see that today, let me just refer to 2018, we've got something like $77,773. And again, those are purchasing power adjusted. And that's different. That's not the same as the US, where it's over $60,000, $62,000. And again, this is not the spending per capita, but an indication simply of GDP per capita, which is an indication of consumption potential. But you can't compare India's, even though it's rising rapidly, to what is even in China. And China's in 2018 is about $18,000, more than twice India's. And here we see Brazil and Mexico, and notice that Brazil's has come down recently because of its difficulties, while Mexico's continues to rise. But Brazil is at about $15,000, and Mexico is about $19,500. So these are simply relative indicators of consumption potential. But you can see that Brazil's indicator is faithful to what's been going on in the economy. So let's keep moving along here. Here are trends in unemployment rates. Notice that China's unemployment rate just hovers at a very low level. As I speak to you, the US unemployment rate has really come down from much, and it's much lower than the IMF projected when these charts were done. It's already down here at the same level as China's. So this graph is not right, probably needs to be prepared or updated. It'd be interesting to see whether IMF's numbers have been updated as well. But in any event, you can see these trends in unemployment rate. And here in Latin America, we have Argentina, which at one time had lots of trouble, and then sort of spiked up again recently. And we can see also that Brazil has had its difficulties right up and has the highest unemployment rate of any country in this chart right now. And that corresponds to what we were looking at earlier. Here's a chart that is consistent with what we were just looking at, and that is inflation rates. The dotted line is India's, and even though it's come down, it's still the highest inflation rate on this chart. Again, I'm kind of wondering whether it's accurate. Today, it looks like, or in 2018, it appears that this chart, which again is IMF data, probably 5%. I imagine that India's inflation rate is perhaps a little higher than that. You can see that the other inflation rates have been brought down from, in some cases, rather high levels in prior years. That includes China. Let me get back here. So here we have some more inflation rate trends, and these include India, Mexico, Russia, and Brazil. And you can see that Russia's inflation rate was really quite high up until recently, and then along with other economies, the inflation rate has declined. There's a lot more to say, and I might add Mexico's as well. And Argentina's was high, it was pretty high in past years as well. There's a lot more to say about Russia's economy. Russia's economy, it tends to go up and down with the price of oil because it's the most important export there. Something else that has happened to Russia, of course, is that it's been under sanctions from the United States and Europe, which has really caused its economy to nosedive. And I think we'll see some charts that will tell us what the impact of those sanctions and oil price trends have been a little later. So let's see if we can move on. In fact, here are some longer-term trends in interest rates. You can see that in the US and the UK, interest rates, when these charts were done, were about 3%. And these were long-term government yields, 10-year government bonds. But you can also see that because of its high inflation rate, Russia's interest rate was I'm not sure, let me see, well, it says 10 years. So a 10-year instrument in Russia had a 10% interest rate. That's because of higher inflation, among other things, that we saw on the prior chart. And then we have Germany, a stable economy, 1.8%. And the point simply is that interest rates will differ between countries. And so if you happen to be in the financial management of a multinational enterprise, there can be a whale of a difference here between countries insofar as whether you should transfer profits or receipts realized in one country back to the United States. If the interest rates are rising in a country, maybe it could be that the best thing to do might be to leave your money there and let it earn a higher interest rate than it would be if it came back home. On the other hand, when we get a look at exchange rates, that may be different. But another important point, I guess, to make is that if you had a European subsidiary, and particularly one in Germany, Um, I think I'd rather be borrowing money at 1.8% than 3% or whatever it is in the United States. So if you have a German subsidiary, better to finance it locally than to transfer funds from the US. Here we have inflation rates in Brazil and India. And as you can see, recently they were pretty high. These are long-term interest rates. Here's a graph that really needs some explanation. These are the GDP saving rates. And something that you need to stop and think about is that corporate profits are essentially saving. When you and I have income and expenses, normally we spend almost all of our income, but what's left over we can put in the bank as savings. Well, corporations do the same thing. They buy services and they buy goods with which they make products or deliver other services. So they then get income from those things. They have revenues and receipts. They pay for the inputs to make those revenues, and what's left over is profit until they pay the taxes, and then what's left over from that is their net income, and that net income, of course, is the same as what your saving and my savings are. And so if you combine personal saving and corporate profit, you get the GDP saving rate. And you can see that China has more of that stuff than any other country, and it therefore has more funds to invest in infrastructure and to build the economy. You can see that's going down, and it'll continue to go down as consumption goes up in China. But nevertheless, we see that China, one part of the explanation for China's rapid growth is that it has accumulated quite a lot of saving, of capital to reinvest in its economy. Here are some saving rates in Latin America, and Venezuela, for those of you who have been looking at the news, Venezuela lately has just been a catastrophe. It used to be an economically powerful country because it had oil and was able to use that oil to grow its economy. And Venezuela was a wealthy nation. But for political reasons, its society has suffered, and the government doesn't function like it used to. And the companies that were doing business in the petroleum industry in Venezuela are not there any longer. They've left because Venezuela nationalized petroleum production assets. And you can see then that the result in Venezuela has been catastrophic. And Argentina is similarly not well off, and has its GDP saving rate has declined. Here are interest rates, you can see that interest rates in Russia have declined in recent years. Why is that? Because inflation, if you go back and look at the chart, the inflation rate has come down. Also, the demand for borrowed money has gone down because the vitality of the economy has gone down with the reduction in the income from the petroleum industry, and with sanctions imposed on Russia's economy by the United States and the European Union. So in the chart below, we see the exchange rate. And you can see that for a while things were better in Russia because price of oil was high. But in the past couple of years, with the sanctions and oil not recovering enough, you can see that you can. I'm sorry, I'm getting that a little backwards. Up until 2016, I guess it looks like, the U.S. was able to buy more and more rubles. That's to say that, see right here, this is when the sanctions went on and the price of oil declined. Sorry about that. However, in recent years, the U.S. dollar has bought a little bit fewer rubles than at the peak of Russia's problems. So we have a little trend reversal here, but if you look at the number of rubles a dollar will buy today compared to in 2014, you can see that there still is a dramatic difference, and that's due again to a variety of things. Inflation is one, but the price of oil and sanctions, which have pushed the economy down, are important as well. Here's something that very few people in the U.S. are aware of. And that is that China is by far the largest market for cars in the world. Now, this chart reflects only passenger cars. It doesn't reflect pickup trucks, which Americans love to buy. They're not in this chart. And probably some, I'm not sure that all SUVs are, but get the picture anyway. And that is that insofar as passenger cars are concerned, not only are a great many more purchased, pardon me, in China than in the United States and elsewhere, but more are produced there as well. I mentioned earlier that I was in China not long ago, and as we were taking a boat up the Yangtze River, barges full of cars were coming down the Yangtze River in order to go to Shanghai, and other cities to be sold. So in addition to all the cars that you're used to seeing on the road in the United States that are made in the US and Europe and Japan, there are factories in China operated by the same companies. There are also imports into China, and then there are, give or take, a dozen companies in China that make cars. They're just Chinese brand cars. And so the automobile industry in China is a growth industry. It's not a growth industry in the United States. It's a cyclical industry, and it's within a fairly narrow bound. But in China, as you can see from this graph, the auto industry is a growth industry. And so, among other things, all the US and European countries and the Japanese countries want to be in China as well. But the biggest auto market and the biggest auto industry of the world is in China. So let's take a look at a little bit of information about trade. Here we see America's trade with its top 3 partners. I think there's actually a quiz question. What are America's top 3 trading partners? Canada, China, and Mexico. That's the answer. Used to be that Japan was right up there at the top, and but China took its place and then some. And we can see that exports are the dark line, and imports from China, for instance, greatly outnumber our exports to them. And of course, that's been a big issue from our current government's administration. They feel that those the dark and the light parts of those bars should be about the same size. So we're more satisfied with Canada, Mexico. It looks like we're going to, we've just, as I'm doing this recording, there have been some recent agreements with Canada and Mexico to restructure our, what used to be called NAFTA, now has a new name, has to be what am I trying, what's the word I'm looking for, confirmed by our Congress and probably the other governments as well. But it's pretty much a done deal. And so the dark and the light portions of these bars will undoubtedly change for Canada and Mexico anyway. As you probably also either know or should know, we're having our difficulties with China. We want China to be a more equal trading partner, and of course China needs to export to keep its economy vibrant, and so it wants to keep exporting, which means it wants us to keep importing, and so there's a discussion underway, then, and it's going to be a difficult one to resolve. So if you line them all up, here are the major countries of the world, their imports and exports. And you can see that the United States imports a great deal more than it exports. So it has an unfavorable balance of trade. It has what's called a negative balance of trade because its current account in the imports less exports, exports less imports, it creates a negative number. Conversely, China exports more than it imports, and so does Germany, and not to the same extent. And the others are pretty much, you know, there are some like the United Kingdom that imports more than it exports, and that the size of the circle indicates the size of the economy. And you can see that Japan exports a little more than it imports, but the three big circles are the ones that often get a lot of attention. I'm sorry, I'm having a little difficulty with my throat. I'll try to hold on here. Hold on, let me see if I can. Find something to moisten my throat with here so I can get through this. The chart that you see on this slide, these charts came from your textbook, and you can see that they end in 2010. The dark arrows indicate where some event has caused exports and imports to decline, and of course that was 2008. When we had our big recession in this country. But notice when we get down to foreign direct investment, when countries, pardon me for doing what I'm doing, but this throat lozenge that I just put in my mouth is sticky. You can see that when we have a recession, as we did in 2002 and 3, that really put the brakes on outward investment, that is investment by US investors into other countries. And we had, again, a rather nasty recession in 2007, 8, and 9. And the result, of course, again, was a reduction in investment. So trade balances, imports and exports, are influenced by recessions. but much more severely, direct investment is influenced by recessions and expansions. So here we see some of the major importers of the world. And you can see that the US and China are the two big ones at the top, the red and the green. Notice that I've got China indicated there as total because there are two components. One is Hong Kong, which is yellow. I'm sorry, let's see. I don't know what color Hong Kong is now, but China is the yellow one, that's mainland China. And then in addition, we have Hong Kong, and I really can't tell which is which here, and I'm not able to pick it off the chart. You could almost do it by a process of elimination. This is Germany, that's Canada. So China is down here somewhere. So it's but you need to put Hong Kong and mainland China together to get total China. And so China and the US are the big importers, and then third is Germany. So here are the exporters, the big exporters. And of course, the number one guy is China. I'm sorry that the legend is a little garbled here. But again, we've got mainland China, and then Hong Kong would be way down here somewhere. And then, let's see, we have what would be, golly, whatever the green one is. This may be the United States, and this light blue is Germany. So here we have exporters, and the big one, bigger than anything else here by a long shot, is China. Here's a table that indicates surpluses and deficits of US, China, Canada, Mexico, Japan, and India. And it's easy to look down at the bottom. You see imports and exports, and these are in, let's see, trillions of dollars. The difference is the trade balance, positive or negative. So Japan, you can see recently, has had a positive, just barely a positive balance, but pretty much imports equal exports there. Notice that in India, the imports exceed the exports by about a third in last year. And that's a pretty reliable number. So India is a net importer. The US also is a major net importer, is it not? See, about the imports are are more than a third larger than exports. Canada is pretty much in balance. China is a net exporter. You can see some years a third, some years a quarter, but it's a big exporter. And again, Mexico is in balance. So just to be sure that you appreciate that if you took all the countries, imports and exports, and added them up, you would, except for measurement error and some inventory accumulation or liquidation, imports and exports would be about the same. So when we see back here on this chart, imports greater than exports, or vice versa, these things balance out so that worldwide, imports and exports are pretty much the same. Now, what's also kind of interesting is what happens when the economy shifts. So here's Germany. And you can see that Germany maintains its exports over its imports. And if its exports go down, so do its imports, so that it maintains this nice, comfortable surplus. That is very important in the European Union because Germany is a major supplier of capital to the European Union. Now take a look at Russia. Russia also has a surplus, but look what happens when exports drop, as they have when the value of oil declined. Look at this, from half a trillion to over a half to under a half to about a third to almost a quarter. As they went down, the imports also went down. And so Russia maintained this rather substantial surplus. And so this is a this is an indication that Russia is maintaining this surplus, even though there's an ongoing demand for products that are imported. But Russia just does not want to incur the deficit that would be required to maintain its imports, and so it controls them. Okay, now rather interesting is the balance of payments for the United States. And if you've heard the news briefings by President Trump, you know that he's very unhappy because the U.S. has a negative trade balance, a big one. And here you can see the trend of imports and exports. Imports are the dark line, the solid line, exports are the dotted line. And the difference between the two is over on the right. You can see it's always below zero. And it frankly recently has had an unfavorable trend. The economists can differ about this, whether this is good or bad. I'm not going to get into that now. I'm just going to point out that the trade balance for the United States most definitely is negative. But that's not the whole story. Here it is for goods, you know, tangible products. And here it's worse. It's actually worse. If I were to compare this balance to the total, this would be lower than the total. See, this gap between imports and exports is wider than the one we just looked at. So what explains the difference? And here it is in services. Now, what do we have? Exports of services, whether it's our banking services, consulting services, which I managed a consulting firm. We provided services to clients outside the United States. But there are lots of services. Construction is a big one. Engineering services, as I said, banking and financial services, and good old management consulting, among many other services. And those services have provided a positive trade balance. So one thing that the current administration might consider doing, instead of putting the clamps on imports of products, and it needs to be some balancing there. But maybe what we should be doing is promoting the exports of our services, because you can see that in the past we've done pretty well providing services to other countries. This happens to be a chart that I'm not going to go through the details of with you, but remember that our biggest trading partners were China, Canada, and Mexico. The European Union, again, consists of 28 countries, and So if we consider it one trading entity, then it's larger than China, Canada, and Mexico. But and these are trading partners with the United States. And normally we think of individual countries when we think of our trading partners. And so there we have China, Canada, and Mexico again, with exports and imports in 2017 and the relative trade balances. Worldwide, we ran a trade deficit last year of almost $800 billion, almost $1 trillion. And the 150 billion of that was with the European Union, but 375 of it was China. Oh my. 70 was Mexico. So a question that often is raised is just, and I got this chart from Statistica, as you can see, but international commerce requires companies to set up subsidiaries, that is, corporations that are owned by the parent company in other countries, or divisions, which are just collections of assets owned by the parent company. But the subsidiaries especially are under regulations regarding how much profit they can repatriate back to the United States and so forth. Sometimes companies want to leave their profit in the other country, and we'll see why in just a minute, but I'll sort of telegraph the move to you. Supposing that the exchange rate, the number of euros that the dollar can buy is going up, that the US will buy more euros. That means that the value of the euro is going down. Well, in that case, if the value of the euro is going down, we might want to get that money repatriated pretty quickly. On the other hand, if the value of the dollar is going down rather than the euro, if the value of the euro is going up, if a euro will buy more dollars in the future than it does today, maybe what we want to do is leave our profit in that country and bring it back in dollars when we can buy more dollars with the same amount of foreign currency than we can today. And so this is the kind of question that, as international finance and chief financial officers, always looking at exchange rates. Now, sometimes, and the alternative, the other factor in the equation is taxes of the home country. And as I hope you're aware, the U.S. has just gone through a major change in its tax laws and lowered the tax rates that apply to profits that are bought back to the United States. But up until that point, here's what the result was. And this was as of 2016. And these numbers got larger after this chart was made. But you can see that Apple had a quarter of $1 trillion, 246, almost $250 billion outside the United States, just sitting in banks over there, wherever there was. In Asia in particular, I would imagine. But after the tax law changed, Apple now has less incentive to keep that cash offshore. Pfizer had just about 200 billion. Microsoft had 142, and so forth. You can read the rest on this chart. So one reason that companies might want to keep the money offshore is because they think that although it's valued at $250 million today, that same amount of foreign currency might be worth 300 billion 90 days or 6 months from now. And so that's one reason. And then the other reason, of course, was the tax rate. If they brought it home, they'd have to pay the government a large portion of it. Today, they would pay a smaller portion. So there's less reason for taxes anyway to keep that cash overseas. So here are some exchange rate trends. Here we see and these were done by the Federal Reserve, obtained from the Federal Reserve Economic Database, which is managed by the St. Louis Federal Reserve Bank, which is considered to be the economic center of the Federal Reserve System. Lots of economic power in the St. Louis Fed. And anyway, that's another story. But that's where these data came from anyway. So you can see that this chart shows the number of yuan that a US dollar will buy. Now, when I was in China, I think that we were getting about, oh gosh, maybe 6.7 something like that yuan to the dollar, and you could see that if we had waited and gone a little later, we could have gotten almost 7, and now it's come back down again. Reasons for that include, among other things, diplomacy, negotiations between countries, but for as long as that line was going up, it made it easier for the US and other countries with strong currencies to buy Chinese goods because they could get a favorable exchange rate. And by the same token, and so if you will, although the line goes up, that's in the US's favor, but it's in China's disfavor. What it means is the Chinese currency is worth fewer dollars because $1 will buy more yuan. So if you made profit in China and you were able to take that profit back to the United States as a chief financial officer, what would you do? The answer is you'd get that money transferred just as fast as you could, because the longer you wait, the less dollars it'll be worth. On the other hand, in this most recent trend here, when it's coming down, maybe we should wait, right? Because a dollar will buy fewer yuan, which means that the yuan is getting stronger. So if I've got 100 yuan here, I'll get fewer dollars for it than I will down here. So if this chart keeps going and I wait, if I bring the yuan back, I'll get more dollars for those yuan than if I exchange the currency today. Here it is for India, and you can see that India's economy, its inflation rate was high, and you can see the same sort of pattern that we just looked at. But it's got some different characteristics, and of late, the dollar has weakened a little bit just in the past year. By the way, look at this spike here. When things like this happen, there's usually a political, some sort of an external factor, some sort of an external shock that causes that. Here's Brazil, and you may recall what I told you about Brazil's economy and the turbulence of its government and the instability of the government, which has caused foreign industry to leave the country, certainly not invest in it. So the dollar bought more and more and more Brazilian reals. And now, because of austerity measures, the dollar is buying fewer reals. We'll wait and see what happens. Looks like we've got kind of a leveling off going there. Here it is in Canada. Once again, you know, the dollar was strengthening. We had a curtailment, and I really don't recall what the reason for that is. A banker would tell you in an instant, because that's very dramatic. And here we are again with the dollar weakening against the Canadian dollar to the point where $1 US today buys $1.25 of Canadian currency, whereas in the past it's purchased a lot more Canadian currency. Here we are with Russia. I was in Russia this year, and we were getting something like 65 rubles to the dollar. But you can see again the same pattern, only it really goes up because of what it goes from 30 rubles to the dollar to 70, almost 80. So the ruble's value really cratered because you could buy so many more of them with a dollar. And then just recently this year, the dollar has generally weakened. This isn't because Russia's done anything wonderful. It's just that the U.S. Federal Reserve policy, the monetary policies, and have caused a reduction in the U.S. dollar's purchasing power. Here's Venezuela, and if I did this chart today, that line would go up even more. It would virtually go right through the screen. The inflation rate in Venezuela, I'm not sure, it's in the hundreds of percents. It's just terrible. But you can see what's happened back here in 2002. It was 1 bolivar to the dollar. Here in 2017, it was 10. And now I don't know what it is, but it's a lot higher. So the bolivar and Venezuelan currency isn't worth very much. And that's again because of their governmental stress and turbulence in Venezuela. Here we have something that you need to know. This chart is interpreted in exactly the reverse manner that the charts we've looked at so far. In the charts we've looked at so far, we've looked at how much foreign currency $1 will buy. Here, we are looking at how much US currency 1 unit of foreign currency will buy, in this case, the euro. And if we were to turn it upside down, we would get the same charts we were looking at. These are just this is the pattern that we've just looked at, but it's turned upside down. And so during this decline, the euro would buy fewer and fewer dollars. Up here, it would buy almost $1.40. Down here, in 2015, it bought just a little more than $1, and now it stayed pretty low for quite a while. Now it's working its way back up because the dollar has weakened rather than strengthened as it did here. Now, the charts that look this way are the euro, the British pound sterling, and the Australian dollar. There may be others, but those are the ones that are most important. And so when you're looking at a chart of currency exchange rates and you see euros, British pounds, or Australian dollars, you're talking about how much US currency, that foreign currency will buy. Otherwise, you're talking about how much foreign currency the dollar will buy. And that's the end of those slides. Now, what I'd like to do, and I know this is dragging on, but I want to real quickly just go over a couple other items that were on those slides that were provided to my online Business 370 class. So let's real quick, let me see if I can just pick them up here. And they're about petroleum. And there they are, and energy. Yeah, here, and I hope I've got one more chart, but this chart shows the production of energy. Now, this is not just petroleum and gasoline. This is electric power, just energy production, which includes electric, primarily electric power. And you can see that with its rapid growth, China is by far the largest generator of energy in the world. These are in British thermal units, and they're quadrillions, as I recall, of British thermal units, but just measures of energy. The second largest, no surprise, is the US. And Russia, rather interestingly, is it's not the third largest. There are, I believe, some there may be others that are larger. We don't have the European Union here either, by the way. We just have individual countries. But you can see, and the purpose of this chart at the top is to show what the impact of Russia's economic growth is. Also to confirm it, to grow an economy takes energy. But don't confuse this with petroleum or oil production. This is the production of power, of energy. Now, be careful. See, here on this chart, we're talking about over 100 quadrillion BTUs. But here, the top of this chart is only 22. That's down here somewhere. So be sure to look at the scale as we look at these charts. And we can see that Canada is up here in the 20s at the end of 2015. Sorry, these charts are a little old. But the 20s is way down here on this chart somewhere, right? Yet we can sometimes see trends. You can see Indonesia, for instance. The Southeast Asian nations offer the promise of relatively rapid growth in the future. I won't go into the details or the reasons why, but Southeast Asia is another growth region of the world. Down here, we see Saudi Arabia. Saudi Arabia, believe it or not, is one of the largest users of solar energy in the world because they've got lots of space to put solar generators, mirrors essentially. So you can see that there's quite an upward trend, not just due to solar power, of course. It's a very large exporter of petroleum, as you surely know. Here's Iran and Iraq. So I think what we're doing is putting the Mideast nations here simply to point out how large they are compared to the size of these guys. And the very largest number here is about 25, which is somewhere down here on this chart of the big three. So believe it or not, that's all I have on that chart. Let me see if I can get rid of, you can't, I don't think you can see what I'm doing, but I've got something that's sort of stuck here on my screen, which is getting in the way. Okay, now, we may be done, but I had, and I hope I still have, yeah, one last slide. And this is production. This is the petroleum of oil and other petroleum liquids. There are all sorts of things that come out of a refinery. I used to, our consulting firm worked for some refineries, and there's a catalytic converter unit in the center of a refinery, and as the crude petroleum gets refined at various stages, products that are petroleum come out of that petroleum, not just oil, kerosene, butane, just all sorts of stuff. Anyway, all that stuff is in this chart. And you can see that the U.S. in recent years has taken a leadership position due to our production of what's called shallow oil, using fracking techniques, which have some real environmental issues attached to them. But the U.S. has caught up with and surpassed Saudi Arabia. Nevertheless, you can see that Saudi Arabia also is a great big producer of petroleum, and Russia, some people are not aware, but Russia is a major producer of petroleum and provides petroleum and natural gas to Europe, to Western Europe and Eastern Europe. And so the Russian production is of petroleum is very important to the European economy. Then you can see all the others, including China. And as you can see, among other things, China's production actually has declined a little bit. And so when we take a look at imports, and a little later on in this chart, bear in mind China and Russia and the US. So here are the exporters, and number one among the exporters is Saudi Arabia. I don't know whether we can pick off the U.S. here, but we don't export very much. We use almost all of the petroleum that we produce. So this is Russia, the red line. The black line is Saudi Arabia. This one that's moving up real fast is Iraq. As a result of the deal that was done between the Obama administration and Iran, Iraq and Iran have both begun to produce more. We'll see what the future holds there. And finally, importers. And so the U.S. has been an importer. The red line is 2015 and the black line is 2016. So we're a big producer, and yet we're a big importer. But when we get to China, China is a small producer and imports even just about as much through 2016. And as its economy continues to grow, I would imagine that it will continue importing large quantities of petroleum. Now, the offset to that is something that I mentioned earlier, and that is that China is engaging vigorously in renewable energy production, solar. It's also building dams to produce hydroelectric power. When I went through China, not only did I see the world's largest dam at a place called Three Gorges, it's a monstrous dam. You just can't imagine how big it is. But there were some 13 other dams on other rivers that were either under construction or planned. So China's going for, in a big way, for hydroelectric and solar power, probably wind, although I saw none of that when I was there, and I haven't read anything about it. You can see that India, which produces, I don't think they're even on this map of producers, are they? No. And so basically India imports essentially all of its petroleum. So does Japan. And so and please bear this in mind. These economies, Japan and India, I imagine Korea the same, and Germany is the same. These economies are dependent for their energy largely on imported oil. And so as the world political economy fluctuates, when we have these times of turbulence or strong differences of opinion, or trade wars, something of that sort might occur, the countries that are dependent on other countries for their petroleum, and I'm thinking of Western Europe's dependence on Russia, Japan's dependence upon petroleum from probably Saudi Arabia, and perhaps in the future the United States, because the U.S. is going to start to export more. What you've got is politically and economically very sensitive, vulnerable situation, because without energy, or with a reduction in available energy, an economy really has to put its brakes on. And so this last chart is sort of an appropriate finish for this video, because it tells you where the soft spots are, where the tender spots in economies are, with the U.S. going more and more for producing its own petroleum, as well as solar. Things are looking pretty good. Saudi Arabia, of course, is independent, and it's more so as it develops more solar. Russia can produce its own petroleum, but it depends on these other countries buying its oil also to support its economy. So if those other countries begin to buy oil from the U.S., or if they begin to develop more solar or other forms of renewable energy, that's a vulnerable point for Russia's economy. And we've already talked about China, and how China is importing so much petroleum, and yet engaging very vigorously in producing renewable sources, so that it won't have to be dependent on other countries as much. So before my throat wears out entirely, I'm going to bring this to a halt, because we've covered everything we need to cover. And I hope that this gives you a little bit more insight into trends of foreign economies, international trade, and the production and consumption of power, including petroleum sources. So with that, I'll try to find the right button to close this this video out, and hope that it's been of some help to you. Goodbye.